Hey traders, welcome back to Smart Trading Tactics, where we break down advanced trading concepts and strategies in a simple and practical way. Today, we're diving into a hidden gem from the trading world, candle range theory, CRT. This concept has been kept relatively secret by the ICT trading community, but once you master it, you'll see your ability to predict price movements skyrocket. Candle range theory is not just another trading strategy. It's a powerful model that can give you a unique edge in the market by helping you anticipate price movements before they happen. Sounds exciting, right? But before we get too ahead of ourselves, let's walk through everything you need to know about this theory in detail. By the end of this video, you'll have a crystal clear understanding of how CRT works, why it's so effective, and how to use it in your trading strategy. As always, if you're new here, don't forget to subscribe and hit that notification bell so you never miss out on any of our future videos. Let's get into it. What is candle range theory? At its core, candle range theory revolves around understanding how each candlestick on a chart represents a range of price action. When you zoom out to a higher time frame, each candle may look simple, just a high and a low, a body and a wick. But what you're actually seeing is a snapshot of price movement over that period. Zooming in reveals much more detail about what happened within that candle. For example, let's say you're looking at a weekly candle. From the outside, it looks like a single, simple price movement. But when you zoom into a 4-hour chart, you'll see that this candle is actually made up of numerous smaller movements, all of which contributed to the final high, low, and close of that candle. In this way, every candle is a range of price action that can be broken down into smaller digestible components. The beauty of candle range theory is that it allows you to analyze how these ranges interact with market phases like accumulation, manipulation, and distribution, the three essential cycles that price action goes through. Mastering CRT enables you to understand where you are in this cycle, which can be a game changer when it comes to executing high-probability trades. To fully understand candle range theory, you first need to grasp the concept of accumulation, manipulation, and distribution, AMD. Every price cycle follows these three stages, and they form the backbone of CRT. Accumulation. This is the phase where the market is gathering orders. Price typically moves sideways, consolidating as traders on both sides of the market place their orders. You can think of this as the market building up potential energy, waiting for a breakout in one direction. Manipulation. After accumulation, the market often sees a quick spike in one direction. This is the manipulation phase. It's where the market takes out liquidity, grabbing stop losses, or forcing traders to act before reversing course. This is where many retail traders get trapped, but understanding CRT will help you avoid these traps. Distribution. Once the market has completed its manipulation phase, it enters distribution. In this phase, the price moves toward a predetermined direction based on the previous manipulation, continuing until the next accumulation begins. These phases create what we call the power of three. It's the heartbeat of the market, and it's happening every single day, across all time frames and instruments. This cycle is what drives price action, and by understanding it, you can begin to predict what the next move will be. Now that we know how accumulation, manipulation, and distribution work, let's bring it back to candle range theory. Essentially, each candle forms within the context of these three phases, and by zooming in and out across time frames, you can see how a single candle represents a larger range of price action. Here's the key. The price range between the high and the low of a candle on a higher time frame, let's say the 1-hour chart, is actually made up of smaller, detailed price movements when you zoom into a lower time frame, like the 15-minute chart. What looks like a simple movement is actually the result of several smaller ranges interacting with each other. Each time frame tells its own story. When you understand the relationship between these time frames, you can start to see patterns, such as how liquidity is taken and where accumulation or manipulation might happen next. For example, if the price has just completed the accumulation phase during the Asian session, you might expect manipulation during the London session and distribution during the New York session. This is the typical AMD model in action, but there are important variations to watch out for. As we've mentioned, The market moves in cycles, and each session, Asian, London, and New York, plays a role in this. Understanding what each session does is crucial for identifying and trading CRT patterns effectively. Asian session. Typically, the Asian session is a period of low volatility, and price tends to accumulate. This doesn't mean that manipulation or distribution can't happen, but more often than not, the market consolidates during this session. London session. London tends to be the most volatile session and is where manipulation often occurs. The price will sweep liquidity during this session, creating opportunities for those who know what to look for. Finally, the New York session often acts as the distribution phase, where the market continues the trend that was set in motion during London. Here's a pro tip. If you notice that the Asian session has already expanded significantly, don't expect the London session to manipulate the market in the usual way. Instead, it's more likely that the London session will accumulate, with manipulation happening later in the New York session. This little detail can make all the difference in your trading success. Recognizing CRT patterns. One of the most effective ways to identify CRT patterns is by using candlestick formations. Let's talk about one of the most common CRT setups, which involves a 3-candle sequence. First candle. This candle sets the range with its high and low. Second candle. The second candle sweeps liquidity by taking out the low in a bullish setup or the high in a bearish setup of the first candle. Third candle. The third candle breaks out of the range, confirming the CRT pattern. This 3-candle sequence is a simple yet powerful way to identify a high-probability CRT setup. However, it's important to note that CRT patterns aren't always confined to just 3 candles. Sometimes the sequence will involve more candles, but the principle remains the same. Bullish and bearish CRT models. The beauty of CRT is that it applies to both bullish and bearish markets. Let's break down how you can spot these patterns. Bearish CRT. In a bearish setup, the price sets a range, sweeps the high of that range, and then breaks down to the downside, indicating that distribution is about to begin. Bullish CRT. In a bullish scenario, you're looking for a candle sequence that sets a range, takes out the low of that range, and then breaks out to the upside. This sequence signals that the accumulation phase is over and the price is ready to move higher. The trick to recognizing these patterns is to keep an eye on liquidity. Liquidity pools, or areas where traders' stop-loss orders are likely sitting, are key to understanding when and where the market is likely to manipulate before making its next big move. One of the most critical aspects of using CRT effectively is timing your entries. You need to be aware of the key times when the market is likely to form CRT patterns. In the Forex market, there are specific times when price action tends to be more reliable for these setups. 1 a.m., 5 a.m., 9 a.m., 1 p.m., 3 p.m., 6 p.m., 9 p.m. These times are crucial because they often coincide with the opening of major trading sessions, which is when we see the most volume and volatility. If you're trying to identify a CRT pattern, make sure to look for these setups around these key times. To effectively use CRT, it's important to align your entry time frame with the time frame where you identified the pattern. Here's how you can think about it. If you identify a CRT on the monthly time frame, use the daily chart for your entries. If you spot a CRT on the daily chart, look to the 1-hour chart for your entries. For CRTs on the 4-hour chart, the 15-minute time frame is your go-to for entries. If you're working with the 1-hour time frame, you can enter on the 5-minute or 1-minute charts. This alignment ensures that you're not only identifying the CRT pattern, but also entering at the most opportune moment. Executing trades with CRT. Once you've identified a CRT setup, the next step is to execute your trade. Here's a step-by-step guide to help you execute your trades with precision. Identify the range candle. This is the candle that forms the CRT range. It sets the high and low of the range, giving you the boundaries you'll be working with. Wait for liquidity sweep. Look for a candle that sweeps liquidity by taking out the low or high of the range candle. This is the manipulation phase. Enter on the breakout. Once the market has swept liquidity, wait for a candle to break out of the range in the direction you're anticipating. This is your entry point. Your stop loss should be placed just below the low for bullish setups or above the high for bearish setups of the liquidity sweep candle. Target the range's midpoint or extremes. Depending on your risk tolerance, you can target either the midpoint of the range for a safer, more conservative target, or the high-low of the range for a larger profit. Let's now see examples on a live chart. Here we have 1-hour chart of United States dollar versus Japanese yen, USD JPY. Price just reacted inside this bullish fair value gap, a key area to consider. After a small rally with bullish consecutive candles, we see price at exactly 1 a.m., a key time, a bearish candle forms. This is our candle range. Firstly, we mark the high and low of the range candle. Currently, we have an order block here. This will be our new and unmitigated PD array. Let's jump to a 5-minute chart. This is the same area on 1-hour chart. This is the range candle on 1-hour chart. We cannot enter blindly just because price has swept the low. We have to wait for a change of character. Take note, we do have an order block here on the 5-minute chart. You can refine your order by using this one here. Now we can patiently wait for the price to reach this order block. This makes it a high probability CRT setup. Finally, we reach the order block. Next step, we need the change in character. Another high is formed, so we can delete this one. Okay, we have a close above candle, but we have to wait for this break to be confirmed with another close above candle. This why it powerful to wait and follow your rules. We wait for this break to be confirmed. All right, we have now closed above, confirming the change in character. We will enter on this order block and place our stop loss just below the order block or below the previous order block. We gladly target the middle of the range candle or the extreme high of the CRT range. This one was the perfect example of CRT model. This strategy can be the best confluence to use in your strategy. Let's move on. Now, let's look at another example, this time with EUR/USD. On the 1-hour chart, we spot a CRT pattern forming around 9 a.m. The price sweeps liquidity below the range, reverses, and breaks out to the upside. Again, we zoom into the 5-minute chart to find our entry. We place our stop just below the liquidity sweep and target the high of the CRT range. The price moves in our favor, and we hit our target, closing the trade with a nice profit. Mastering CRT in your trading strategy, candle range theory, is a powerful tool that can help you predict price movements and improve your overall trading strategy. However, like any strategy, it requires practice and patience. The key to mastering CRT is to become familiar with how different time frames and market phases interact with each other. By understanding how the accumulation, manipulation, and distribution phases play out across different sessions and time frames, you'll be able to spot CRT patterns with greater accuracy and confidence. That's it for today's video. I hope you found this deep dive into candle range theory informative and actionable. If you're ready to start incorporating CRT into your own trading strategy, be sure to practice on a demo account before going live. As always, trade smart, trade safe, and always stick to your plan. If you enjoyed this video, give it a thumbs up, and don't forget to subscribe to Smart Trading Tactics for more content just like this. Until next time, happy trading.